If you go back to the early 2000s, the U.S. was natural gas short. Natural gas was up to over $13 per MCF, believe it or not, versus $3 or less today. Oil actually hit over $100 at one time, back down to below 70 as we sit here this afternoon. The U.S. was looking to build 40 LNG import terminals. Today, of course, the investments are in exporting given the supply growth that we've had in natural gas in this country. Think about fracking and the revolution that occurred back in the 2008-2009 timeframe. How that changed the landscape, not only from a business standpoint, but geopolitically, as far as the posture of the U.S. in the global markets. And think about the geopolitical events that occurred. Iraq, Russia, Ukraine, Crimea, all the China issues, Iran, you can go on and on and on and on and on. Of course, we've been through several administrations in Washington on top of that. Think about the various acronyms that have evolved during this same 25-year period. ESG, COP, Paris, net zero, EVs, and you can go on and on and on and on. All that has occurred since that Y2K timeframe. But again, the common theme is not only survival, but this industry has proven itself time and time again to be resilient. Go all the way back 150 years to the beginning, at least here in the U.S. Think about whale oil. Think about kerosene. Think about the Industrial Revolution. Think about deep water. Think about fracking. And now think about renewables. This industry, its talent, its technology, its innovation knows how to address society's problems and redefine and reinvent itself over and over and over again. If you take nothing else away from today's discussion, the one thing I could say that is certain, in 25 years, there'll be people sitting here having a very similar discussion regarding the future of the energy business from 2050 to 2075. We will be here. I will mark and guarantee that point.
We'll be here?
Hopefully.
I hope so, yeah.
We as an industry will be here.
You'll be here.
But with that, I'd like to start by asking each of these gentlemen to give kind of their crystal ball outlook and vision of the next 25 years. And let's start with you, Eric.
Well, thank you. I think the next 25 years, and people are not going to really appreciate this, they're going to kind of look like the last 25 years in the sense that you're never going to have the perfect political situation anywhere in the world. You're never going to have a flip the switch and we'll be 100% renewables kind of event. What you're going to see is a gradual evolution over time. We will figure out ways to produce renewable power cheaper. We will figure out ways to use it in the locations where it's most applicable. But one thing I'm convinced of is, as Randy said, we're going to end up with energy on the menu, and some of it is going to be hydrocarbon and some of it's not. So we have to learn and adjust and be sensitive to the fact that what works in the Gulf Coast may be most important to us, but perhaps something different applies in California, something else different applies in Canada or the Eastern Seaboard. And that's just in the U.S. You've heard panels here with Paulo yesterday on what's going on in Latin America. That's a very diverse population compared to the U.S. But the fact of the matter is they will have solutions to their problems. They will solve their energy problems because they don't have any choice. And so will we. That's my guess on what's likely to happen. It will take longer than we thought. It'll cost more than we anticipated, but we will still be here and we'll still be using these various product options to optimize our solutions.
Thank you. And Bill, your thoughts?
Yeah, just to build on what you guys have said, if you think about resilience, and I go back in history to think forward in what's going to happen in the future, starting in 99, 98, 99 was a downturn in the business. 2002, 2003 was a downturn. 08 was a downturn. 16, 17, 18 was a downturn, et cetera, et cetera. So we've had, and in my career, starting in 1980, I've probably seen 9 downturns, but I've probably seen 9 upturns, of course, too. And I think we'll see that in the future. Since oil and gas is a commodity, there's supply and demand issues all the time. 30%, current energy use around the world, 30% of it is cement, steel, fertilizer, and petrochemicals, all of which are hard to impossible to do any other way than with oil and gas. So that's a third of the mix of the energy needs for the future. So number one, we got to figure out how to do those things cleaner and or with new processes, and we'll see that. The same thing on transportation. I think 16% of the worldwide CO2 comes from transportation. 8% are vehicles, and so a small portion of that right now are EVs, which are cleaner. They're not 100% clean because you still got to build them and that sort of thing. But so that's a small portion of it. So we've got a lot of challenges ahead. Fossil fuels are still about 80% of the worldwide energy supply, from maybe 85% a decade or two ago. We're making great strides in solar, wind, and other clean and cleaner solutions, but starting from really small footprints, but with large percentage changes. But there's a long way to go, and I tell students at Tulane, I tell people that we're trying to hire at Jefferies, we need you all to figure it out technically, financially, politically. It's the big challenge of our time, really, and we heard a lot about that in the last 2 days.
Thank you. Adam?
Yeah, I'm going to bloviate a little bit longer. You guys did great. So as a way of introduction, my name's Adam Frey. I'm a partner at Bain & Company. To talk a little bit about my work, Bain & Company, we're one of the big 3 strategy houses, and I'm an oil and gas specialist, so I've worked really closely with executives pretty much across all of the super majors, depending on what you think about Repsol, and also a lot of the independents. And that's given me a front row seat into how the paradigms are changing and really how the top teams and the ELTs are thinking about this. So I've prepared a couple trends and implications that I see. I am going to be talking about oil and gas companies in general. This may have a bit of an upstream flavor to it, but this is meant to be sort of all of them. The first one is, as I said, 150 years old, this industry is, and really it's always been an engineering problem. It's why all of the CEOs of these companies are engineers, and very few commercial people at the top of this. And that works really well when it's an engineering problem. Find the rocks, produce it safely. The demand will take care of itself. The trend is we're seeing that change. We're seeing that shift. We don't know when demand is going to start to plateau and eventually fall for oil and gas. We expect by 2050 we're going to see that. That seems to be the consensus. But ultimately, if we have uncertain demand, the pressure to be more commercially minded is going to be larger than it's ever been, and that's going to cause a shift in how they think. And I got a couple of implications after this. So that's number one. Number two is who controls the resource is shifting. In the future, the vast majority of resources is going to be state controlled. Some of it is going to be national oil company produced. That's going to put further pressure on fiscals. The oil and gas companies will get less of the net value from that oil and gas, and that's going to cause them to have to work differently, and it's also going to have to cause them to engage differently with those NOCs. And in some cases, for the independents, they may be even completely shut out. And so the engagement models are going to have to shift there. And the third one is around investor pressure for decarbonization. 3 to 5 years ago, huge investor pressure to decarbonize operations, to get into new energies businesses. I don't have to tell Randy about the Engine 1 proxy battle at ExxonMobil. All of the investor proposals to be more transparent with their emissions profiles. That pressure has waned, but the effects of that pressure still remain. And all of these super majors now have these new energies businesses. They're investing billions of dollars of capital. They've got top talent working on it. This stuff remains. And so that's a trend. that we'll talk about. So there's three implications of those trends that I want to hit. So the first one is a new approach to investments. The way that oil and gas companies have gotten to financial investment decision, FID, has been essentially the same because they never really had to worry about demand. 30 years from now, I know demand's going to be here, so I'm going to model out my production, and I'll make my biggest risk is price risk. Well, if demand isn't going to be there 20 years from now how do I model this? You're already starting to see a slowing down in FIDs. You're already starting to see in some areas that capital isn't being deployed as quickly as it was. That's not true for everybody, but it's true industry-wide. We're going to need to see an evolution in that. One of the evolutions that I'm seeing is something I'm calling fiscals-led investment, which is, if you look at any tornado chart, the top two things that move oil and gas investments are how big is the resource and how good is my fiscal regime. Well, in the past, it used to be, well, just go find the rocks and the fiscal regime will take care of itself. What we're now starting to see is these super majors are looking for opportunities in good fiscal environments. Those good fiscal environments are typically in undeveloped countries. So things like, they're trying to find the next Guyana, to say it as easily as possible. So you're starting to see those exploration strategies, and that's a fundamental shift, and I expect we'll see that over the next few years. I'll wrap up. So the second one is the challenges in new energies. Nobody's recording me, right? So I am not, what I would say is these new energy companies that Chevron, Exxon, BP, that they've all started, they aren't making a single dollar yet, or at least whatever dollars they're making, it rounds to zero based to the rest of the business. I don't expect that new energy adoption or new technology adoption is going to be coming from these super majors. I think that is going to be coming from smaller, private, startup type companies. And that makes sense, right? The GM and Ford didn't make electric cars popular. Polaroid didn't make digital cameras popular, right? So it makes sense. Where the super majors and the larger oil companies do play a role is in the scaling and the quick adoption of those technologies as they become less nascent. That's going to be the opportunity. This is an industry that has not adopted technology very, very quickly, so that's going to be a struggle. But it's something that they're going to need to do. And the final thing, and this is the one that's most exciting for me, is you're actually starting to see daylight in strategies. Because this was an engineering problem of an industry, it was everybody's strategy was essentially the same, and it was some flavor of do better, right? You're starting to see different strategies now. You look at what BP's done. You look at what Exxon's doing. You're starting to see winners and losers. I'm not going to say who wins and loses, but you can figure that out. But you're going to start to see some winners and losers, and that's really exciting, especially as somebody who provides a service of strategic advice. So, and it's a great time to be in the industry. I would tell most people to be in the industry. If you take anything away from what I'm saying, I'll echo what Randy said, which was it's not going anywhere. It's not going to be a straight line between now and 2050, but I'm confident the industry will figure it out.
Thank you. Well, gentlemen, let's assume we're sitting in a boardroom right now. These are our board members. Come January 20th, we have Trump 2.0, the drill baby drill champion. As you're advising on the future horizons to 2050, not just for the next 4 years, but for these long-term investment horizons industry undertakes, what would you be counseling your board members? Let me start with you, Eric.
I would counsel all of my board members to go talk to their congressman and make the case that tariffs don't mix with oil and gas very well. That if you want to have tariffs as a short-term political solution, figure out ahead of time how you're going to get out of them. We've been through this within the last decade with the Chinese. The Chinese are very efficient at putting in countervailing duties the minute you raise your hand to say that you want to put a tariff on EVs or a tariff on, any of the multitude of products that come out of China. The people in Washington so far don't seem to realize that they will do the same thing. If we put tariffs on EVs, they'll put tariffs on the products we sell them. And I say this as a very narrow Louisiana-focused outlook. Louisiana is one of the biggest exporters to Asia in the United States. most of it being petroleum and petroleum intermediates. So if we like selling 3 million barrels a day of NGLs to China, or at least to Asia, with the intent of making plastics and bringing those plastics back into the U.S., we do not want to put a tariff on EVs, because we're going to see a tariff on our products going out, and it'll be instantaneous. So it's not something, the tariff might let you win 1 or 2 battles in Congress, but within 12 months, you're under the wheels of the truck. So that would be my advice. Put maximum pressure and remind President-to-be Trump that he's tried this before and it didn't work before. It's probably not going to work again.
Bill?
I would say the play your own ball as a company. Continue to do what you've been doing. This is my hat of the U.S. producer, whether they're a major or an independent. The last 8 years or so, investors have insisted on profitability rather than growth. And, prior to that, in the shale boom from 08 till 14 or so, it was growth for growth's sake. Spend 130% of your cash flow. I'll reward you for growth. But we found so much hydrocarbons that we killed the price, killed the profitability, and it turned out, E&P companies were lousy investments during that time. On the one hand, they were fantastic for giving the U.S. probably the lowest cost of supply in the world. With all the oil we found and all the gas we found, we became net exporter in gas. We became net exporter in oil. But keep you're expected to have a 30%, 40% cash flow margin. Keep doing that. That depends on prices. That depends on worldwide impacts, not impacts of an administration. So, and at the same time, keep your eye on how the regulatory environment changes. And one thing I would wish is that we sort of don't overplay our hand and get rid of all the regulations, which ultimately kind of leads to backlash. For instance, I don't think there's anything wrong with any methane regulations. We shouldn't have methane leaks. We shouldn't have methane going into the atmosphere. It's 25 times more harmful than CO2, and the companies have at least voluntarily decided we're going to fight this, and they're led by the majors. We're going to fight leaks, is what I'm saying, and we're going to voluntarily keep our eye on being really good stewards of that, and then taking away the environmentalists being able to attack us that natural gas is bad because it leaks, even though it's half the CO2 of coal. So think about what regulations you need to adhere to.
Adam?
I think in prime numbers, so I've got 3 things I would say. And I think you guys both hit some of these, which is first one is this is a global commodity. This is a global business. The administration in the United States and their and what they're driving towards is not going to really move you too much. Now, what I will say, and the second part I'll say about that is how much is actually even federally controlled lands. Actually, a lot of the states are driving a lot of the regulations and the slowing down. When you look in the Bakken, they're full go. North Dakota is good to go. When you look at the DJ, the Colorado government is really slowing them down. When you look at New Mexico and the Permian, it's also slowing them down. So there's a state government element of this. And when you look at the federal lands, I mean, we're talking about Gulf of Mexico, which isn't really a growth asset anymore. Of course, there's some opportunity. So I guess I would say is it'll be some impact. The second thing I would say, though, is we're talking about 30-year assets. Most of the time, when we're putting things in, we aren't worried about the next 4 years. We want to know what this thing is producing 30 years down the road. So the implications of today, maybe it gets us to FID, and that's good, and let's take advantage of those. But it doesn't change the way that we need to evaluate our investments. And the third thing, which I'm now forgetting, so maybe 2's a prime number, so I'm going to stop there.
Save it.
Yeah.
Okay, well, let's change the venue in the audience. Let's move across the Atlantic to Brussels. And the 3 of you gentlemen are now advising the European Union and the commissioners, knowing that they've been very proactive, including the non-U.S. oil and gas companies, on the Go Green front, the environmental movements, etc. And of course, you had the Yellow Jacket response. You just had a decision out of a Dutch court last week throwing out an order against Shell regarding emissions and targets being mandated to be met. What would you be advising the European commissioners right now as to what they should be looking forward to and planning for over the next 25 years, given these tensions?
The first thing perhaps I would suggest is if they don't want revolutions, those are never much fun. If they want to have a stable government, they'll do exactly what the Germans did, which was say, that was then, now is now, we need a different policy. Germany went from 0 LNG import terminals, 0, to 5 in 3 years. And why? Not because they suddenly fell in love with natural gas, and not because they wanted to build ships and terminals. It's because their industry and their population depended on energy. It's a pillar of all rich, north of the equator populations, and you mess with it at your peril. So that wouldn't be very good advice, perhaps, to get reelected, but it might save a couple of countries from going through a very messy internal disruption.
Bill?
I would add, my mantra is when you think about energy sources, think about affordable and reliable and cleaner. And that's a healthy way to think about your choices. And what's happened in Europe has been led by cleaner, cleaner, cleaner. It's sort of been cleaner and cleaner and cleaner. Is and they have really good intentions of doing this, and they have the social license that people want the government to do this and the industries to do this, but they miss the affordable and the reliable part, in my opinion, in some cases. Germany shut in all the nukes after Fukushima. They banned fracking. They started importing 40% of their energy as Russian gas, and then they went heavy duty on wind and solar, which are great for clean, but are intermittent, so they're not necessarily reliable 100% of the time, and they're not necessarily cheaper. So Germany now has the highest cost of electricity in Europe. That's led to a lot of manufacturing leaving, and it's led to, I think, a 10% downturn in energy use, which is a proxy for manufacturing, and it certainly made their GDP go down. And a lot of the businesses are leaving for areas like China that use dirtier fuels. So all their great intentions they individually had, when they put it all together in their formula, didn't work out so well. And I wish they could think more holistically. I'm not saying we are perfect here, of course, but you got to think affordable and reliable and cleaner when you're talking about this. And people, Annika talked a lot about this morning on people paying extra for green premium. It's really hard to get either people to pay extra for green premium or governments to fund cleaner stuff that costs more, because they can't do that forever. They can't deficit fund cleaner energy supply. So.
Adam?
Yeah, not much to build. Energy security has got to be a major goal, because, to your point, the unintended consequences of people seeking out the energy is going to be dirtier. There was they were shutting in potential production in the North Sea, which is great. Everybody was happy, and then they were importing it from dirtier, higher carbon intensive locations.
And pardon me, and they're adding coal plants. They're restarting coal plants, which again is the opposite of what they really want.
Completely right. And so just to say, hey, guess what? We're not doing this anymore isn't how it's been working. They will find other energy sources, because the alternative to not finding energy sources is death, frankly. And so that is the worst thing we can do. The best thing we can do is give them some energy that is clean. There is a way you can track that path. You can produce in a cleaner way, a lower carbon intensive way. We're moving that way in the United States, and I feel really proud of that. I think there's opportunities to do that elsewhere.
Let's continue on our world tour and move to Riyadh. MBS has asked the three of you, OPEC Plus, we still have a lot of influence on the market, on pricing, obviously supply. As you view the world over the next 25 years, what would you be advising me as to my role with Saudi Arabian crude, the rest of the OPEC plus countries, and so forth? What's your counsel?
My counsel will be do more of what you've already been doing, building LNG terminals with people from the Middle East, or building new offshore developments in shallow water, which we don't really do anymore, but certainly the Persian Gulf does. So I would even say figure out a rapprochement with Iran and do it in cooperation with the Saudis and with the other folks who are impacted by that decision. Because I'd rather have them in the tent with their nose under the tent than to have them on the outside, lobbing missiles at me. So.
And we did hear throughout the conference today how, this administration did get in contact with Saudi Arabia and certainly did have some impact and influence.
That's right. Elon Musk is already reportedly talking to the Iranians. So I suspect that's not going to be the ultimate outcome, but I do think that perhaps most of our golden age in this kind of arena was when we were talking to everybody and working with everybody. Some of the people were not particularly pushing our goals, but again, we had a dialogue with them. They weren't doing anything too rash at the time. So that would be my advice, is keep up the good work.
Bill?
I think you see the Saudis and others thinking a lot about how they diversify their economy. They're very, 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 very heavy hydrocarbon based. On a high percent of their revenues are from hydrocarbons, and Aramco and others I think are doing a lot of work in where are we going with a long vision into cleaner hydrocarbons, number one, or number two, outside of hydrocarbons. So I would pay attention to some of the things they're doing and they're studying, because they're thinking a lot about that.
And Adam?
Yeah, I mean, to the point, they are spending billions of dollars to have their own energy supply be non-hydrocarbon based. That's so that they can sell us more of it, and they can take some of the cash. I think they recognize that the time is now to monetize their resource, which is why they're able to play games on price and production and mail that in. What I would say to him though is it's still a global commodity, and I recognize that we should all work together, but I'd be even more competitive than I think they have been in the past. I think there's an opportunity, and that might not be good for me personally, but if I were them, I think there's real opportunity for them to put more pressure on IOCs and basically what I'm saying is if they ramped up their production, the FIDs will go down even further, and then they can really corner the market. So if I was talking to him, I'd probably say get more aggressive.
Well, that raises the question: do you feel that the U.S., with its current supply outlook, can in effect overtake OPEC Plus and become the world swing producer in the global oil market?
I would tend to doubt it. We don't have a prince, we don't have a king, we don't have any kind of unanimity. We do have a sort of enlightened self-interest with a bunch of large major companies who are consolidating in the shale fields. Don't forget, shale did not start with Shell and Exxon and BP. Shale started with people like Chesapeake.
Right.
The shale revolution was in spite of the majors, not because of them. But at this point, the majors are rapidly becoming the major owners of the shale plays. So it harkens back to what you heard earlier. If you're looking for innovation, you look to the smaller, more adroit players. If you're looking for scale advantages, you swing to the majors.
Bill?
It's too we're too diffuse. They're, the largest producer. Golly, we produce 13 million barrels a day. Who's the largest producer of oil? Was it
You mean globally?
Yeah, no, U.S. wise. So it's a few like, okay.
With
Chevron
USA
and Chevron and Exxon
and
are
with
headed to
Chevron
1 million barrels a day.
Right.
So 1 million out of 13 million will be the largest producer, and then you have many companies below that. So I think it's too diffuse to act all in concert. What gets people acting in concert is what's financially attractive, what do shareholders want, and what are shareholders insisting upon, and they're going to insist upon free cash flow and dividends and that sort of thing.
Yeah, let me clarify. I was not suggesting by my question that the companies act in concert.
No, I'm not.
It's more that the U.S. is in its own competitive
yeah.
landscape.
Yeah, no, I'm
will
not.
produce more and then compete in the global market.
Well, remember, too, this is the moral equivalent of a world war. And to the degree that we're not shooting at each other is certainly good news. But when we win wars like World War II, I tend to fixate on that one, it wasn't because we all took a lot of votes. It was because we had to win a war. And you saw companies like Exxon and the Baton Rouge refinery here innovating and building the first cat crackers in the world and building the first butadiene plants in the world to make synthetic rubber. We didn't have any rubber. We never have had any rubber. And unfortunately, at that point, the Japanese had all the rubber. So we had to come up with a solution. Exxon, with government support and contracts, went out and solved that problem for us. And the other point was at the beginning of the war, we had 6 million barrels of oil a day production, not 13. But the rest of the world only had 4. And Japan and Germany had 0. So my first reaction to those numbers was, what were they thinking? That's not the way to win a war if you don't have any fuel to support it.
And it's 13 out of 100 now, for perspective.
Right.
The 100 million barrels a day of production.
You've all read that Russia's economy is smaller than Texas's economy, and it obviously has always been heavily reliant on oil and LNG potentially. What does Mr. Putin do over the next? He won't be around for 25 years, but in planning for the next 25 years, given the global challenges of sanctions, of obviously the Ukraine war, the administration here in the U.S. How does he address this global next 25-year challenge for his country?
That's a really good question. I think that he's interested in at least internal political stability first and foremost, and he's got to figure out a way to generate that. The sort of the luxury of being able to control a bunch of Eastern European countries as buffer zones has kind of gone by the wayside. In a sense, this is more of a European problem than a U.S. problem, but the U.S. is one of the king posts of NATO, and NATO seems to be doing a better job than it's done in the past. I think President Trump will argue that the Europeans have to pay a greater share of the cost, and the U.S. a lesser share. But at the end of the day, if everybody's paying 2.5% of GDP, there's enough money around and enough troops around to maintain a status quo. And I think it's in Putin's interest to maintain that status quo. His problem is he can't be Peter the Great, and he can't go out and take over Eastern Europe without consequences.
I think 80% of his revenues are from oil and gas. And we tried to attack that, and I think we've done a pretty good job of cutting off the normal trade flows. They're finding new ways. A lot of it's going to India now, and to China, and to other places. And I think that's what he probably thinks about all the time. But the more we can do to sort of attack those supply lines for him, the better to push back hard on Russia.
Adam?
I'm just an engineer, Randy. I don't know. No, I mean there is a Western. Europe is wealthy and hungry for his oil and gas. I know that there's a lot of history there, and I'm sure there's other things there. If I was looking at it from pure business perspective, that's where I'd be wanting all my resources to go, and I'd be doing everything I could to make that happen.
Let me ask one more question before we ask for the audience's questions. Matt Simmons, several years ago, before he passed, sadly, had a theory of peak oil. What are your views as we sit here today, almost into the year 2025, on his thesis from years ago of peak oil?
I'm reminded of the who was it, Sheikh Yamani at one point was the running Saudi Arabia's oil and gas, and he said the Stone Age did not end because we ran out of stones. And I think peak oil is one of those sort of theoretical constructs that worked pretty well at the time, but took no. And this was predicting 1970 as the peak, as I recall. And what I think Matt made the mistake of was essentially repeating the same accident the Shell geologist did, which was saying that technology won't change. And what's happened every time we look is technology did change. Now, it might have been George Mitchell figuring out a way to frack rock. It might have been his partners in crime who figured out how to drill horizontally. But, people came up with a way to exploit a reserve that had never been exploited in the past and to do it efficiently. And I think that's not going away. You can look at Guyana. Everybody and his brother, including the U.S. government, had postulated that there was oil there. Problem was nobody had found it. Shell went in, Exxon went in, Shell backed out and sold their share to Hess. And then Shell, Hess, and guess what? CNOOC, biggest offshore portion of the Chinese oil and gas industry, jointly developed those fields. And they are, each field is on the order of 200,000 barrels a day. So it's at the rate they're going, they could match the Gulf of Mexico production in another 10 years.
Kyle, let me ask you any questions from the audience?
Yes, sir. Quite a few. Beyond tech and cost efficiencies, can you address the challenges of selling new energy sources on and off the utility grid?
Bill, Adam?
But I'll say I know most of the super majors do not want to be in front of the meter, because then you become a regulated public utility. It's a no-go for them. Now, they are generating their own electricity behind the meter for their own operations, and they're also starting to plug in. So when you talk about something like an urban environment like the Permian, where I have a well and there's somebody else's well right next to me and I can sell him electricity behind the meter, they're doing that. But in terms of putting electricity on the meter, my understanding right now is that's a no-go for most of the super majors.
I think you'll see, along that same line, I think you will see some of these massive single installation facilities that use 200 or 300 megawatts at a pop, like an LNG export terminal, putting in capacity for their own baseload applications, but then having the ability to sell it into the market opportunistically. So I think that's sort of the kind of approach you're likely to see. We can't come up with a scheme that says, well, Cheniere or Sempra or any of these other big developers can afford to go in and build their own power supply or preferentially bid in the existing nuclear power supply to run their plants at the expense of the other industries and the residential and commercial consumers. But I do think you can see a situation where a public service commission would say, if you want to pay for it, you want to build it, and you want to give us an option to use it in extremist situations, we'll be happy to let you do that.
But I think they might think about it as lower return businesses too compared to upstream. I think they like upstream, they like the risk, and they think they can manage the risk, and the risk comes with higher returns too. So just like they think very carefully about midstream investments, meaning pipelines and that sort of thing, and they generally prefer the pipeline companies to do that, except if they want control. I think they tend to stay away from this.
That's a great point.
I think, and I'm going to interrupt
Come on,
for
no.
just 1 second. I think the other thing that they will do, both in power and in gas and some of these other energy sources, is they will maximize the use of existing infrastructure. It makes no sense in the world to say I'm going to shut in 3 million miles of pipe because I don't like natural gas.
Mhm.
They'll figure out a way to use the existing infrastructure the same way they're using, obsolescent hydrotreaters to do, renewable diesel and sustainable aviation fuels. They will, and we should applaud that and encourage them to do that, because we simply can't afford the time or the money to replace the entire infrastructure that took us 100 years to build.
Kyle, next question.
Yep. There are a couple of questions just on the oil and gas companies as far as ethical reasonings and business decisions. So kind of sum it up is, how do these companies incorporate environmental externalities such as carbon pollution into investment decisions?
It depends on the jurisdiction. I would say that from a purely financial perspective, it would be competitively incorrect to put an arbitrary carbon price on my on my investment to decide if I go with FID. Because if I do that and somebody else puts it at zero, they're gonna win every time, and I'll go out of business. That's the limit of that. So I would say most companies are not in their FIDs putting arbitrary carbon prices on there. I do know that they are thinking about carbon intensity. I know that they are a part of the metrics that they look at. They are looking for higher returns and lower carbon. So I know when they get to concept select and they're deciding how to develop these, they are trying to do it in the least carbon intensive way. But in terms of like structurally in the financial ways, unless there is some regulation, which there are in Europe, unless there's a regulation, it's not going into the financial calculation.
Any other comments? Kyle?
Yeah, I think maybe just one more question. A lot of the session panelists have talked about how important oil and gas industry and energy as a whole in the Gulf region. So this question kind of goes into that the oil from the deep water Gulf has some of the lowest carbon intensity in its extraction compared to oil from other sources. Will capital investors in the near future more carefully differentiate O&G sources based on environmental factors?
Well, I think you're already seeing some of that when you see the reporting requirements, like low carbon LNG. I thought that was an oxymoron when I first heard of it from the Koreans. But the fact of the matter is, you can, with proper documentation, promote the use of LNG based on the emissions history of that material, and then minimize the amount of CO2 generated when you produce the LNG itself and put it on a ship. So when you get into export markets, you are selling essentially on a delivered basis, and somebody's picking up the tab not only for the production of the resource, but for its transportation, storage, and delivery. And that's one of those things where I think the U.S. could certainly improve its performance, and in effect be a model for other LNG suppliers from around the world.
Yeah. I want to go to something Bill said, which is these are tremendously risky investments, both from a safety perspective, from we don't know what oil price is going to be, plus we kind of know what the resource is, but we don't actually know how much resource we're going to be able to develop. So to take on that much risk, you demand really high returns. U.S. onshore ROCE's in the mid-20s. I think Gulf of Mexico's in the low teens. If there are investments that people want to take, and for that carbon intensity, they'll take a lower return. But I think you'll see some of those come out. I don't know how widespread they'll be, but I would expect that there'll be appetite for that. We
are out of time. Let's give a big round of applause for these three distinguished gentlemen.
And Randy.
Randy.
And also, before we leave, I want to give a toast to all of you for your continued intelligence when it comes to helping to solve the future of energy, your passion, your innovation. Each of you will continue to play a key role. The fact you're here to me demonstrates, as I said at the outset, the energy business is here to stay. We will be here hopefully for many more years to come, and some of us will be here in 2075 to continue this discussion and to look back as what we talked about today to see how much has really happened in reality. So again, thank you, and on to happy hour.
Cheers, Randy.
Thank you.